My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach, put this kind of day in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. If there were 11 million people out there searching for jobs, you know that wages would be going lower. But how about if there are 11 million jobs looking for workers? Then not only are wages headed higher, so are interest rates. That's what we learned from today's employment report, and it convinced a lot of money managers that the Fed will have to move quickly to stamp out inflation before it really gets out of control. Now, if rates are headed higher, that means the stock market's probably headed lower. That's a pretty good axiom. So the good news that jobs are plentiful, we've got just 3.9% unemployment, is greeted with the yawn on Wall Street. So the Dow dipped 5 points, S&P declined 0.41%, and then the Nasdaq really laid an egg. It lost another 0.96%. Man, is it bad Nasdaq land? Look, I've been saying since November when the Fed started tightening, the conceptual companies with expensive stocks get hammered. You know, the ones that don't really have any earnings, they sell on sales. And the tangible companies with real earnings start going higher, especially ones that are cheap when we look at the price to earnings multiple on those earnings, okay? That's what matters. Bond yields jumped again, and those rising long-term interest rates spread to mortgage markets, causing the housing stocks to roll over hideously today. Doesn't matter that mortgage rates are still at just 3.5%, which is an absurdly low number historically. Higher rates are good news for the banks, though, so their stocks have what I call an exaggerated move higher. Meanwhile, the specter of Omicron threatened to overwhelm our entire healthcare system, and it's something you and I must be worried about, whether we've had Omicron or not. But that is a good place to start our game plan for next week. Because when I look at Monday, all I can think of are the hundreds of thousands of people who will get sick this weekend in our great country, many of whom won't even know it and will silently pass it on to others. Some money managers will be buying the stocks that do best in a Fed-mandated slowdown, something that seems more likely after today's employment figures, while others are going to search for bridge stocks that can bounce once Omicron burns through the whole population because it's spreading so fast. And there they're thinking about airlines, travel, and leisure plays. Everyone contracting Omicron in some sort of mass herd immunity is the worst way to beat this pandemic. But this thing is moving so fast that, well, you can practically see it peaking on the horizon, hence why people are starting to think about stocks involving travel and leisure. Monday sees the beginning of the most influential analyst meeting of the year, and that's called the Jpmorgan Healthcare Conference, something that's being held virtually, or we would have headed to San Francisco to see it in person. Fortunately, we have the host of the conference, Lisa Gill, one of a handful of analysts that I am willing to put on the show to tell us what presentations are most likely going to move stocks, because make no mistake, this conference sends stocks flying like no other. Only one company of consequence reports some money, and that's a company called Tilray. That's a pot stock. That's a reminder of how devastating these have been to your portfolio. Forget gateway drugs. These are gateways to capital destruction. The $6 stock once ticked at $300, although that was during a short squeeze. Since that moment in 2018, it's been all downhill for Tilray. Let's see if the redoubtable CEO, Irwin Simon, can alter that direction. When Albertsons wallowed in the teens last year, I came out here and I said the grocery chain deserved to trade much higher. Well, sure enough, after a couple of good quarters, buyers chewed through a lot of stock, and it quietly doubled. Now, Albertsons has pulled back a bit from its highs, but I think it has a lot more room to run. Might be worth picking some up Monday ahead of its Tuesday report. Also on Tuesday, oh, this is a good one, Dell's presenting at an industry conference. And we're going to hear Michael Dell, straight shooter, talk about his company's prospects now that it's fully spun off VMware. I buy some before the meeting and buy some more after. Well, we'll talk to the CEO, too. But what really matters with Michael Dell is that he has made you money for decades now. And he's also an incredibly generous, charitable man. On Wednesday night, we're going to get some insight into the housing situation when KB Home reports. Now, if you're worried about the impact of higher interest rates on the home builders, you might be surprised to see the stock going higher after the quarter. I think it will be a very strong number, even though KB isn't a best-of-breed operator like Toll Brothers or Lennar, and that's because I think that interest rates will not go up every single day. Lots of people keep speculating on when travel and leisure will bottom, as I mentioned at the top, because they want to reach over the gulf of COVID to see what it looks like on the other side. You always see that with Marriott buying, happens constantly with the cruise ships. We get to hear from Delta Air on Thursday, and that's the prism we need to use. Not how Delta's doing now. It's not doing that well, but how it could be doing once we get over Omicron. And by the way, once we have international flights. Do they think business travelers will come back? Can they staff their planes sufficiently? Are fares going higher? Well, I like Disney for my travel trust and think that American Express can keep running. I'm skeptical about how far Delta stock can go in this environment. Friday is when earnings season officially begins, and we could have some real fireworks in our hands, which is what happens when you get gigantic runs in stocks that don't necessarily have all that much good to say. Take Wells Fargo. Now, we've got a huge position in this one for our Travel Trust, which you can follow by joining the CNBC Investing Club. I urge you to do that. It's a lot of fun. We're doing a lot of good stuff. Now, I think 2022 could be a much better year for Wells Fargo than any year since 2017. It's not clear to me that the stock can keep rallying, given that it's already jumped 14% in the past week to 52-week high, like so many others. But I think if it pulls back, we're going to just keep telling you to buy it. You've got to stay tuned to your club bulletins. Then we get to hear from BlackRock, which has surprised endlessly to the high side. You'll get a great analysis of the world, not just the bank, not just his business, from CEO Larry Fink when he explains how well his company's performed in the last quarter of the year. I know I make it sound like there's no guesswork here, but historically there really hasn't been. This is just a sensational company led by a sensational CEO. Then there's Citigroup. Is this a new and improved Citi? You wouldn't know it from the stock, which has lagged helplessly during one of the great banking rallies I've ever seen. Can CEO Jane Fraser tell a tale that makes the stock catch up? Honestly, I just want to understand how the company isn't allowed to buy back stock, every share it can want to, because the stock's so cheap versus what's known as its tangible book value. Citi said it had to pause the buyback in a speech in December because of an arcane regulation. I want to know more about that. Capricious government or wayward bank? We need to know. Finally, let's end with a bang. Jpmorgan. Jamie Dimon. Jamie will tell us what the heck is going on in the banking and in business, in both domestically and around the world. I love his commentary because I get to crib from it for months on end. That's how good it is. Jamie, who's one of those execs that everyone calls by their first names, tends to be very optimistic, but he also mixes in a few Molotovs along with his otherwise easy-to-down economic cocktails. It's a bit of an odd time right now, almost as if many stocks have to take their medicine and then get back on track. This week we saw the unprofitable techs get a drubbing, which then spread into the more mature, profitable ones. And at the close today, well, it made me feel like that the despair is beginning to hit that nasty level that often signifies a bottom. In the meantime, the industrials and the banks were red hot. At this point, it might actually be worth it to circle back to the techs that aren't too expensive, as the biggest industrials finished the week with declines. That was a signal that maybe they've peaked. It's a bad rotation. I will help you with that later in the show. Will the buyers ever return to the profitless SPACs and IPOs that were pumped out willy-nilly by greedy bankers and their venture capitalist compadres? The bottom line, maybe that'll happen one day. But it's a heck of a lot easier to buy the stock of an established company that's actually making money. Yep, earnings are what matters again. Tangible GAAP earnings. Who'd have thunk it? Let's go to Omar in New York. Omar.
Hey, Jim. Happy New Year.
Same to you, Omar. Thank you. Thank you.
Thank you. I was interested in GAAP, ticker GPS. Incredibly iconic, but they've been struggling as of late. And I saw that Kanye West released part of a contract, assuming that Balenciaga may be involved in some sort of collaborations. They're down tremendously from the 52-week highs, but I'm wondering, is now the time to go long?
You know, we had Gap on, and there's so many really incredible apparel stocks. Like, look, I'll give you a great example. This is what you need to know. The Travel Trust owns American Eagle Outfitters. It's been a very bad stock, dude. All right, I always play with an open hand. But it's got a 3% yield. It's got really good management, and it just bought this great infrastructure. And yet it's horrendous. The stock is just awful. How can I not recommend that stock over Gap, whose business isn't that good? So here you have a business in American Eagle that is just fantastic, and the stock is a nightmare. I'd rather be in that than a stock who the business is a nightmare too. Let's go to Julie in Minnesota, please, Julie.
Hi, Jim. Thank you for taking my call.
Of course.
I'm one of your investment club members and want to thank you for all your wonderful advice you give us.
You're very kind. Thank you.
I am presenting a stock next week to my all-women stock club. Shout out to my Dream Big Investment Club ladies. I was going to talk about Beauty Health Company. I saw you, the CEO, on your show last June. I bought some in July. I held on to it, grew to almost $30 a share in November, and now I think it's hovering around 23. What's your take on the future of SKIN?
Oh, wow. Beauty Health. That's Brent Saunders. I think it's terrific. Remember, we also recommended Bausch Health. They have a dermatology business that is, I think, should merge with Beauty Health. I don't think that can happen because of the way that the Bausch is splitting it up. But I would bank with Brent Saunders here. Beauty Health has a fabulous business model, and it is one of those companies that, boy, when we open up from Omicron, it is going to be incredibly strong. I like that stock. The symbol's easy, SKIN. Look, it's all about buying the stock of an established company that's making money. Maybe even gives you a dividend. Earnings are what matter once again. On Mad Money tonight, you can take one look at my mentions column on Twitter and just see how toxic the social media site can be. I have to be one of the top 10 most hated people on Twitter. And I'm Jimmy Chill. What can I say? I'm going to lay out my plan that I think could fix the company for the future. Then, as I've been telling club members, thank you to that very nice lady who said good things about the club, this is the year of companies with real earnings. So I'm revealing a list of real tech stocks that you should keep on your radar. And next week, Jpmorgan is set to hold its annual healthcare conference. I'm getting a preview from this incredibly important market-moving confab with Lisa Gill, the Jpmorgan analyst who runs it. Stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.